Hello, and welcome back to Hank USA. I'm Hank. With July almost here, there are 5 specific financial situations about to hit the wallets of millions of Americans this month. Some involve urgent deadlines closing fast. Others are new fees quietly showing up at checkout. And a couple are automatic payments that could change without warning and affect your bank balance directly. We'll walk through all 5 in order of urgency. We're starting with a deadline that, from the start of the month, is only 10 days away and it cannot be extended. Before that first item, please give this video a like, subscribe to Hank USA, and turn on the notification bell. Major financial deadlines, tax law changes, and payment shifts rarely come with a personal reminder. The government and the banks don't send you a letter warning you that you're about to miss out. Keeping you ahead of these is what we do here. All right, let's get into it. The first item is the most time-sensitive, and you need to handle it before July 10th. This isn't a flexible date or an end-of-month thing you can get to eventually. It's firmly July 10th. It comes out of a federal court ruling, Kwong versus United States, decided in November of 2025 by the U.S. Court of Federal Claims. The court found that the IRS improperly charged a large number of taxpayers with penalties, failure to file penalties, failure to pay penalties, and interest on underpayments during the official COVID-19 federal disaster period. That period ran from January 20th, 2020, all the way through July 10th, 2023. The heart of the ruling was this. Under the tax law that governs federal disaster declarations, all tax filing and payment deadlines during that 3.5-year window should have been automatically postponed. Which means the penalties and interest the IRS assessed and collected during that time may have been charged improperly. After the ruling, the National Taxpayer Advocate put out an urgent public message in the spring of 2026, warning that tens of millions of taxpayers could be owed refunds for penalties they already paid, or could have penalties they still owe wiped out. But here's the key. This relief is not automatic. The IRS will not mail you a check on its own. You have to file a specific claim to get your money back. For most affected taxpayers, the deadline to file that claim is July 10th, 2026. After that date, the right to this refund expires. The form is IRS Form 843, the Claim for Refund and Request for Abatement. You can download it free from the IRS website, irs.gov. Across the top, you write a specific phrase, Protective Refund Claim pursuant to Kwong versus United States. That tells the IRS exactly why you're filing. You'll need a separate Form 843 for each tax year where you paid penalties or interest on obligations due between January 20th, 2020 and July 10th, 2023. Then mail the forms by certified mail to the IRS Service Center for your filing address. Certified mail matters here because it gives you proof you filed before the deadline. 3 important things to understand. First, the Kwong decision is being appealed by the Department of Justice, so a refund is not yet guaranteed. So what does filing by July 10th actually do? It preserves your legal right to the refund if and when the case is finalized in taxpayers' favor. If you don't file by July 10th, the window closes permanently. It won't matter how the appeal turns out. You'll have given up the right to the money for good. That's why it's called a protective claim. Second, this is about penalties or interest you were charged, not just back taxes you owed. Even if you filed every return on time and paid your tax in full, if you were separately hit with a late payment or underpayment penalty during that window, that penalty may qualify for a refund. Third, the major tax prep firms are on top of this. H&R Block, for one, published guidance in June 2026 saying they're actively helping clients prepare and file these protective claims. You can get professional help, or you can download the form and file it yourself. The point is to act before July 10th, and you can file even if you're not certain of the exact amounts, since a protective claim is about preserving your place in line. Now, item number 2. This is an extra fee showing up more and more at the register this summer. One most people don't realize they're now legally being charged. Credit card surcharges. For years, these fees were largely prohibited, but as of 2026, Adding a surcharge just for paying with a credit card is legal in the large majority of states. And merchants are moving fast. Recent surveys suggest well over half of small and mid-sized businesses have already added some kind of surcharge or dual pricing setup to offset the processing fees they pay on every card transaction. The fees can be significant. Under Visa's rules, a merchant can add up to 3% of your bill. Under MasterCard's, it can be as high as 4%. Some states cap it lower. Colorado limits surcharges to 2%, and several states require the fee to reflect only the merchant's actual processing cost, nothing more. In everyday terms, a $200 grocery run on a credit card could now carry an extra $4 to $6 that didn't exist last year. A $150 family dinner could add $3 to $6. A $1,000 car repair could tack on $30 or $40. These add up fast. Merchants are required to disclose the charge before you complete the sale. That might be a small sign at the entrance, a notice on the payment terminal, or a line on your receipt. But disclosure at the register doesn't mean you had any warning before you walked in and filled your cart. Often, you don't find out until the last second. The good news is that avoiding it is simple. Pay with a debit card or cash. Federal rules and the card networks prohibit surcharges on debit card transactions nationwide. That's a key distinction. If a merchant ever adds a surcharge when you're paying by debit, that's not allowed. The surcharge applies only to credit cards. If you routinely put everyday expenses, groceries, the pharmacy, gas, restaurants, on a credit card, it's worth watching your receipts. Over a month, these surcharges can add up to a real number you could be keeping. It's also worth knowing that a few states still ban credit card surcharges outright. As of now, those include Connecticut, Massachusetts, and Maine. If you live in one of them, no merchant can legally add this fee. If you see one on your receipt there, you have every right to dispute it. And the merchant can face fines for breaking state law. Item number 3 is the mid-year tax checkup. The IRS won't send a reminder for this, but skipping it can lead to a surprise bill and penalties next spring. July 1st marks the halfway point of the tax year, which makes it the right moment to confirm you've paid enough in estimated taxes to cover the first half. This matters most for anyone whose income doesn't have automatic withholding, which describes a lot of seniors and retirees. We're talking about pension payments, the taxable portion of Social Security, distributions from an IRA or 401k, self-employment or gig income, and investment income like dividends or capital gains. The IRS requires estimated quarterly payments if you expect to owe $1,000 or more for the year beyond what's already withheld. If you underpay during the year, they don't wait. They charge an underpayment penalty, which lately has run around 7% annualized on the shortfall, and the IRS resets that rate every quarter. For 2026, there's a specific trap that's likely to catch many seniors, involving a major new deduction and how it affects estimated taxes. A recent tax law created a new $6,000 deduction specifically for people 65 and older. It's a real break that can meaningfully cut taxable income for millions. The problem is that many seniors, and even some tax advisors, haven't recalculated their 2026 estimated payments to reflect it. If you've been paying your quarterly amounts based on last year's income and last year's rules, your payments this year could be well off. You might be significantly overpaying, basically handing the IRS an interest-free loan. Or, if other income rose, you might still be underpaying and setting up that penalty. The mid-year point is the time to get this right. The second quarter estimated payment was due June 15th. The next one, for the third quarter, is due September 15th. So you have a window right now to review your finances if you haven't checked that your year-to-date payments line up with your projected 2026 tax, and that includes accounting for the new $6,000 senior deduction if you qualify. Now's the time. Fixing any shortfall or overpayment with your September 15th payment can save you a much bigger headache and a possible penalty at year-end. As always, it's worth running this by a qualified tax professional to be sure your numbers are right. Item number 4 could change how much gets pulled from your bank account this month: your insurance premiums. If you're enrolled in a Medicare Advantage plan, a Medigap policy, or any private supplemental plan, July can bring an unexpected change to your monthly premium, often without a clear explanation. Behind the scenes, insurers and pension systems frequently run mid-year administrative reviews, and some plans adjust their premium deductions starting in July. It might be a mid-year rate change buried in a thick spring mailing you probably didn't read line by line. It could also just be a shift in their billing schedule. The practical step is simple but important. Look at your bank statement or the deduction line on your Social Security statement for July. Compare the insurance premium deducted this month against what came out in June. If the number changed, higher or lower, it's time for a phone call. Contact your insurer directly and ask specifically why it changed. Also ask whether it's a permanent change to your monthly premium or a one-time catch-up deduction. Those catch-ups happen when an insurer shifts its billing cycle, and they can pull 2 months of premium in 1 month, which is a real jolt to a budget. A permanent increase is more serious, and it's worth asking whether it reflects a plan change you actually agreed to. If you never got clear advance notice, press the issue. Ask when the change was disclosed and request a copy of that notice. You have the right to know exactly what you're being charged and why before the money leaves your account. Finally, item number 5, a Social Security payment timing shift that catches some people off guard every time it happens. As we covered in a recent video here, July of 2026 has a calendar quirk that affects 2 groups of beneficiaries. The first group is people who started collecting Social Security before May of 1997, or who get both Social Security and SSI at the same time. For this group, your July payment arrives on Wednesday, July 2nd, instead of the usual July 3rd. The reason? July 4th falls on a Saturday this year, so the federal holiday is observed on Friday, July 3rd. With banks and federal offices closed, the SSA moves the payment to the business day before, Thursday, July 2nd. For this group, it's a minor, convenient timing change. For the second group, SSI recipients, the quirk is bigger and carries a real financial risk. If you get SSI, your regular July payment arrives July 1st as normal, but your August payment comes very early, on Friday, July 31st. That's because August 1st falls on a Saturday, and the law requires the SSA to issue the payment on the last business day of the prior month, when the first lands on a weekend or holiday. So here's the situation. You'll get 2 SSI deposits in July and 0 in August. The trap is easy to fall into. If you check your account at the end of July and see that second deposit, you might think it's extra, a bonus, or some kind of error in your favor. If you spend both July deposits during July, August gets ugly. When rent, utilities, and groceries come due, the account is empty, and that can set off late fees, overdrafts, and a lot of stress. So the check you write for yourself in July, if you're on SSI, is a mental one. When that second deposit lands on July 31st, set it aside completely. Don't touch a penny of it until August 1st. The simplest approach is to treat it exactly like your normal August payment, because that's what it is. It's not extra money. It's your August money arriving 1 day early. Budget around that and you avoid the crunch. So, to wrap up, here's your full financial picture for July. First, file IRS Form 843 by the July 10th deadline if you paid any federal penalties or interest on tax obligations due between January 2020 and July 2023. Write protective refund claim pursuant to Kwong versus United States across the top and send it certified mail. Second, credit card surcharges are now legal and active in most states. You can avoid them entirely by paying with a debit card or cash. Third, before the September 15th third quarter deadline, take time this month to check your year-to-date estimated payments against your projected 2026 tax, accounting for the new $6,000 senior deduction if you're 65 or older. Fourth, compare your July insurance premium deduction to June's. If it changed, call your insurer to find out why. And fifth, if you receive SSI, set the July 31st deposit aside completely and treat it as your entire budget for August. Thanks for watching. This has been Hank with Hank USA. If this helped, please give it a like, subscribe, and share it with someone who needs to hear it, especially before that July 10th deadline. I'll see you in the next one.